Well, it's gaining in terms of momentum, at least for the mid-cap index, so up around 0.6%. Just want to point out that in terms of momentum, we have the Nifty, which is picking up a little bit. We have the Sensex also, which is up around 44 odd points. So maybe there is some amount of traction which is coming through. In terms of a couple of the mid-caps, just keep your eye out on a lot of these infra power stocks. So Rel Infra is up around 3.7%. Adani Power is up around 3 odd percent. Something like a JSPL also gaining up around 3 odd percent at this point. But as Q1 earnings get underway, CRISIL has come out with a report and they see revenue growth to be the slowest in 2 years. And the key factors is deceleration in consumption, lower realizations. To discuss the report, we have Hetal Gandhi, the director of CRISIL, who joins in on the show. Hetal, hi, welcome to the show. So the drop in the growth rate from say 9% in Q4 to 5 to 6% in Q1, where is the bulk of it coming from? It's coming from autos?
Yes, large portion would be autos. So you also saw some other areas like commodities, where because the prices have been benign, the revenue growth rate has come down. And plus the rupee depreciation, while it has continued, the extent of depreciation has been lower than what it was in the last year same time. So therefore you are also seeing that revenue growth rate for export linked sectors like IT services is also moderated. So we believe a combination of these two have resulted into the slower growth, but a larger proportion is contributed because of automobiles and FMCG.
Okay, so you are saying that Q1 revenue growth will probably be the slowest in 2 years. Where is the bulk of the slowdown coming from?
So we are seeing revenue growth rate tapering down to around 5 to 6% in Q1. And this is much slower as compared to the last 4 quarters, which was seeing a 14 to 15% growth in revenues on a year-on-year basis. We believe that the consumption slowdown has the largest component which has contributed to the slowdown, followed by the benign commodity prices. So if you have to get into specifics, automobiles is expected to show a decline in revenues by around 9%. And this is mainly led by lower volumes across vehicle segment categories. Whether you look at passenger vehicles or two-wheelers, revenues are expected to decline on year in Q1 by around 10%. And if we look at segments like commercial vehicles and tractors, the decline is much higher at around 21% and 15% respectively. We believe that the reasons, although, are different for the drop in revenues for each of the segment categories. If you look at segments like passenger cars and two-wheelers, the rise in the cost of ownership that happened somewhere in September last year due to higher fuel prices as well as higher insurance cost in case of two-wheelers resulted into a lower consumer sentiment. However, manufacturers kept pushing sales at the wholesale level, resulting into inventories piling up at the retail level. Some portion of that inventory has corrected, some portion will correct in Q2. So Q1 mainly has been the correction of inventory phase, and that has resulted into the decline in volumes at the manufacturer level. In case of commercial vehicles, we had axle norms that came in last year, and because of axle norms, there was an artificial 20% increase in supply that got created. And this is what has resulted into lower volumes now. This is also in line with what we are seeing in terms of lowering freight rates and lower capacity utilizations at the transporter level. So we believe this decline in revenues of automobiles has contributed maximum to the drop or the slowing down of the revenue growth rate for corporate India.
Okay, 5 to 6%. But Hetal, this 5 to 6% excludes banking, finance companies, oil companies. But if you include these, I mean, overall, what would revenue growth look like?
So we do not include banking as well as oil and gas in this assessment. This is an assessment which is around 300 companies that account for 60% of the market cap. But if we look at banking sector specifically, separately, we do see that there is an improvement in credit growth. So let me look at it separately for public sector banks and private sector banks, because the trends are very different. In case of public sector banks, there have been two positives. One, that your NCLT proceedings have concluded for a lot of cases, and benefits of that have started flowing in. So you are seeing a drop in the GNPA levels clearly. Second, that there are at least 5 banks who have moved out of PCA, and therefore you are also seeing an improvement in credit growth. So credit growth for public sector banks that was hovering anywhere between 3 to 5% last year, this year is showing improvement of around 7.5%. So we are positive on that end. If we look at NIMs, we believe that there is a marginal improvement of flattishness in the NIMs that you would see. In case of private sector banks, we believe that the growth will continue to remain buoyant. We are talking about a 17 to 19% kind of a growth. We are seeing the retail segments on the banking side expected to perform much better. Also, refinancing to NBFCs would be taking place, and that is what is expected to drive growth. NIMs would remain more or less flattish for private sector banks or may drop marginally, and GNPA levels would also be more or less similar levels as last year. You are not going to see a significant drop in GNPAs for private banks. So little different trends for public and private sector banks, but overall from a credit outlook point of view, there is a short positiveness that you are seeing in the system.
So also, when again, NBFCs are not part of this analysis, but have you looked at them in terms of what should we expect?
So we have not looked from a quarterly assessment point of view NBFCs, because you will not see a very large proportion of the sample being listed. But we do have an annual outlook which talks about a moderation in credit growth. We are speaking about anywhere between a 10 to 12% kind of a credit growth for NBFCs.
Okay, Hetal, overall margins are expected to be steady. Does that reflect, say, higher efficiency across the board or lower raw material prices, which could be transient?
So definitely not higher efficiency, because you are looking at segments like auto, where capacity utilizations are expected to drop, and there are production holidays that a lot of manufacturers have taken. We are looking at the margin environment being better or stable for most of the sectors, thanks to what is expected to happen on the commodity prices side. So across segments like auto, where the margin drop could have been much sharper, is now lower thanks to lower commodity prices. For example, steel, we are expecting almost a 5 to 6% drop in prices, and if you look at aluminium, there has been around a 15% drop. If we look at crude oil, there has been around an 8% drop. So segments like auto components, the margin drop is much lower as compared to what could have been in the past. In case sectors like FMCG, which are again facing slower revenue growth, we are seeing that while prices of commodities like sugar, milk have gone up, it has been offset by oil-based commodities that has gone down. So again, you will see stable margins in the FMCG space. I think there are sectors like cement where you would see an improvement in margins because the prices in the cement space have gone up significantly, and over and above that, you are seeing that power and fuel-based costs are actually going down. So that is helping them to actually improve margins. So cement, sugar, these would be the sectors where you will see improvement in margins. Most other sectors is flattish margins. Sectors like automobiles, you will see a drop, but much lower than what you had expected.
Which are the sectors then, Hetal, you see doing very well? If you could just leave us with those thoughts.
What we believe is that there are sectors like airline services where you will see very good revenue growth rate. Structurally and fundamentally, even sectors like IT services and pharma are showing good growth rate trends. So while your growth rate for segment like IT services is coming down as compared to the last 4 quarters, but the structural trends continue to remain good. Digital services growth is very good. You are also seeing a very good growth rate when it is coming to the US markets. So that is much better as compared to what you would have seen 1.5 years back. Similarly, pharma, I think new product launches, niche launches, specialty products being launched is resulting into they having a better pricing power, and volume growth has also improved. So a lot of regulatory concerns which were there, companies are able to offset them to a certain extent and show a good double-digit growth rate in revenues.
Hetal, pretty exhaustive. Thanks very much for taking the time and being with us here on the channel. It's a pretty bleak picture out there, barring a very few sectors across the board. There is pain. The good part is overall margins are holding on, but that's largely because of the drop in oil prices and oil-related inputs. We'll take a very quick break here. We come back and we get some futures and options trading strategies. Krish Subramaniam of Altamount Capital is going to be with us with a few ideas. Back in 2.